Hello, everybody. Hope everybody is doing well. Uh, I'm the tutor of financial reporting and financial accounting paper for more than 5 years. My name is Simon Hussain, and I'm the AFD and ACCA teaching expert. My specialist teaching area is FA1, FA2, FA, and financial reporting. So recently, uh, one of my student from a financial accounting paper scored more than 80%, and another paper which I teach, that is financial reporting paper, many students scored more than 70% in last September 19th session. So I have been teaching in ACCA for more than 5 years. So based on my experience or my technique, I try to make understand the topic easily, and I try to make my class more interactive, so that student can understand the topic properly. And I try to uh, I try to clear all the concept that they feel any confusion regarding any topic after the class. So that's the main strategy to do well in this paper. So today I'm gonna start a topic from financial reporting paper. The topic name is IS2. Okay, so this is the very first initial topic for this paper. First of all, I'll try to make you understand the accounting treatment of inventories. But before that, I need to understand what is the objective of this IS inventories. So the main objective of IS2 is to prescribe or the provide accounting treatment and measurement of inventories. So to give the accounting treatment and measurement of inventories, at first we have to know what is inventory. So guys, see, the inventories, that is a item or any property that is held for business or held by business to resell in the ordinary course of business. So that means any item that held by business for the ordinary course of business is known as inventory. It might be in different form. It might be in work in progress. It might be in raw materials or finished goods that actually held by business for resale. But in this IS, we are not focusing on the movement of inventory or movement of trading inventory, because during the inventory trading, the transaction is recorded by the sales and purchase account. And when we sell anything or when we purchase any item or raw material for resale, so that the double entry should be posted is for purchasing any goods. The double entry should be purchase debit, cash, or payable credit. You guys already know about it. It's the basic core of double entry bookkeeping. And when you sell anything, the double entry should be cash or receivable debit and sales credit. So yes, all are very popular about this double entry. I hope you guys are already master at the double entry bookkeeping system. But particularly in this IS, we are not focusing on this type of journal entry or accounting entry. Rather, we focusing on the accounting treatment, particularly the closing inventory. So first of all, what is called closing inventory? The inventory that yet not sold at the year end. That means, if I give you an example, you have purchased or produced 1000 unit, it is highly likely you are gonna sell whole 1000 unit to your customers. Maybe during the year you have sold 800 unit of product that you have purchased or produced. It means you have remain 200 unit of inventory in a warehouse. That is known as closing inventory. So when you calculate the cost of sales, the question is, do you charge the whole 1000 unit cost with the revenue? Did you sell the 1000 unit to your customer? The answer is no. So when you purchased 1000 unit, that means when you incurred the cost for 1000 unit, but you couldn't make sell the whole unit of inventory. That means you have managed only 800 of inventory to your customers. So according to matching concept, you can only charge the expense of 800 unit goods into your cost of sales. So guys, always remember, when you calculate the cost of sales, the formula should be the opening inventory plus the cost of purchase less any closing inventory, because the closing inventory is not any item that you have sold to your customer, so you cannot charge it in your profit and loss. So from this formula we can see that the closing inventory value is deducted from the cost of sales. That means your cost of sales will be lower and the profit will be higher. And on the other hand, in the statement of financial position, the value of closing inventory should be shown as a current asset, because we are gonna sell it within next accounting year. So guys, be careful when you giving the accounting treatment for closing inventory. So here there is a simple technique of understanding how to impact the valuation of closing inventory on profit or on asset. Simple thing is, if the closing inventory value is overstated, then your cost of sales will be understated and your gross profit will be overstated. And on the other hand, if the closing inventory value is understated, your cost of sales will be overstated and the gross profit will be understated. So in a nutshell, we can say that if the closing inventory value is overstated, then profit will be overstated and your asset will be overstated. And on the other hand, if the closing inventory value is understated, then the profit will be understated and the asset value will be understated. So this is a very sensitive issue to resolve. So that's why we need to give more focus on the inventory valuation, particularly the closing inventory valuation. So now let's get started with the closing inventory valuation part, because I have already told about the closing inventory valuation is very crucial for our accounting records, because if the closing inventory value is misstated, your whole financial statement, so for example your profit and loss will be misstated and your statement of financial position will be stated. So this is very important to record or to measure the closing inventory properly. So to measure the closing inventory properly, which accounting standard we need to follow? We have already mentioned in earlier, that is IS 2. So according to IS 2, the closing inventory should be measured, or the closing inventory should be valued at lower of cost and NRV. NRV means net realizable value. So here we need to identify the two component to valuing our closing inventory. One is cost and another is NRV. First of all, let me explain about the cost. What does mean cost? Cost means the inventory you have already purchased or produced, the all attributable cost that is directly related to bring the inventory at its current condition. So when you identifying the cost, you can consider the nature of business. If the business is in a retailing industry, then the cost will be net of purchase cost. Net of purchase cost means any purchase price less any trade discount or any rebate. Or if a business is involved with a manufacturing or any production plant, then the cost should be purchase cost plus conversion cost. When you calculating the cost, some cost you cannot include your inventory valuation. That should be excluded from your inventory valuation. The item is the non-manufacturing overheads, the storage cost, selling cost, and abnormal wastage cost. That cost should not be included in your inventory valuation because that's not directly related to the producing the inventory at its current location or condition. And I hope you guys already know about the conversion cost. So the conversion cost is the convert the raw materials into finished goods. So that's the third component of cost. So to valuing our inventory according to IS2, I have to take the cost component at first, and then I need to identify the relevant NRV of that inventory. So here we need to understand what is the NRV. NRV means net realizable value. What does mean net realizable value? The value it actually realized by selling the inventory. Now my question is, the inventory will be sold in next year. So here, do you consider the existing selling price or the estimated selling price that you will be able to sell the inventory at that price? So many of the students, they got confused. They always consider the estimate or the original or the existing selling price when they identify the NRV. But the reality is you need to identify an estimated selling price to calculate the net realizable value. And to sell the inventory, there might be a transportation cost or any commission that should be deducted to calculate NRV, because this is not realizable value, this is net realizable value. So I hope you guys understand the thing of how to calculate net realizable value. So now we have already discussed about the cost and NRV. Now which value you should take to valuing your closing inventory? At first, we have already mentioned the closing inventory should be valued at cost and NRV. Now my question is, why we have to take the lower value? Why we cannot take the higher amount? Guys, I hope you guys already known about the prudence concept. That is that is explained in a conceptual framework. So according to prudence concept, you cannot overstate any profit or asset. So here the closing inventory valuation is embedded with a inbuilt impairment test. First of all, if you put the higher amount, the closing inventory will be higher. And what will be the impact of profit? If the closing inventory is higher, the profit will be higher, the asset will be higher. So there is a pure contradiction with the prudence concept. So we cannot do that. So we have to take the lower amount. Say for example, of a pen, maybe a ball pen, the cost of the pen is $5, okay, and the estimated selling price is 7, and the estimated selling expense is $0.5. So the net realizable value is $6.5. Now the cost is $5 and the NRV is $6.5. So which value you should consider to valuing your closing inventory? You guys already know it. The lower amount, the lower of cost and NRV. So I hope you guys got this topic, the inventory valuation. The most important part of this is when you valuing your inventory, you have to consider the lower value of cost and NRV. So next, get in the next slide. Now this is related to calculating the cost formula. When we calculating cost, there are two formula mostly used in IS2. One is FIFO, another is AFCO. But once there was there has been used a LIFO method, but recently the ISB board it's make it prohibited. So now at this version of IS2, LIFO is prohibited. You cannot use LIFO, that is called last in first out. So which formula we can consider? Either we can consider FIFO or we can consider AFCO. First of all, when we can use FIFO or AFCO for any interchangeable items, okay, but if there is a non-interchangeable item, then you can use a specific identification. So now FIFO means the first item of inventory should be issued, which is first in or first purchased, okay, and AFCO means you need to make the average. So here there is a two type of AFCO. One is a periodic average cost method, another is weighted average cost method. So most of the uh, topic or in IS2 we have to follow the weighted average cost because this gives you more accurate figure, okay. So now we need to understand the additional point that is related to IS2. So that was the basic part of IS2, but related to the IS there is additional thing that we need to understand the related point in addition with IS2. First of all, in the previous slide we have already shown you that the cost formula should be chosen either FIFO or AFCO. First thing, can you do that? You will value a group of inventory by using FIFO, and the same item of inventory will be using AFCO, or in 2018 you have followed FIFO method for all of inventory, but in 2019 you are using AFCO, and in 2020 you will be using FIFO. So this thing actually make conflict with our core accounting concept of consistency. You guys hope understand what is consistency. So if it conflicts with the consistency, then it will make problem to compare those financial information. So if you change any method of inventory valuation, if you want to switch from FIFO to AFCO or AFCO to FIFO, then this is a purely a change in accounting policy. Here it's clearly given, if company changes its inventory valuation method from FIFO to AFCO or AFCO to FIFO or vice versa, then it basically a change in accounting policy that is covered in IS2. And we all know that anything that is change in accounting policy is for the changing the accounting policy, we have to provide the retrospective adjustment. So I hope you guys are know about what is retrospective adjustment. If you guys don't know about what is retrospective adjustment, I will make a video on IS 8 on that topic. On that video, I will make you understand clearly what is retrospective adjustment and how to give the retrospective adjustment. And another important point is when you value your inventory at the year end, that time usually, generally, the cost component might be lower than the NRV component. In example, in 2018, there was a closing inventory of which I have already mentioned, pen. The cost was $5 and the NRV was $6.5. So which value we have taken to value your inventory? Obviously $5. So at 31st December 2018, you have valued your closing inventory at $5. But after 31st December 2018, the demand of this pen has fallen, has declined. It became obsolete and the cost remained constant. Why? The cost you have already incurred. So cost component is not changed, but the NRV that you have estimated, which was $6.5, but now it got down below 5 and the NRV become $4. So now guys, what should you do? Can we keep the value of closing inventory of $5 or should we change the value of inventory? Obviously, we have to change the inventory valuation. That is also given the instruction or the guideline provided in IS 10. So, if any item of inventory, the cost component is higher than NRV after the year end, then the inventory valuation should be readjusted. Say, for example, which example I have given, the cost component was 5 but the reduced NRV become 4. So now the inventory value should be cut down to 4. That means we need to reduce the closing inventory value per unit $1. So that is according to IS 10. I hope you guys already know about IS 10. If you don't know about IS 10, no worries, I'm here to guide you. I will make a video on IS 10 and to make you understand properly what is the accounting treatment of adjusting event and non-adjusting event. So no worries, I will make a video on IS 10. So that's the end of the topic of IS2 inventories. I hope everybody understand the IS. And if you face any queries or any problem regarding IS2, then feel free to knock me. Don't feel hesitate to knock me. And here I have shown the contact number or my Facebook page. My Facebook page is ACCAFANFR Study Buddy. Please like my page, share my page. And if you feel any queries regarding any topic regarding financial accounting or financial reporting paper, then without any hesitation, either call me or inbox me in my Facebook page, or you can mail me in this mail. Okay, so thank you everyone. I hope you like the video. You really like the video, so please share with your friends. So thank you.